Okay, we want to finish chapter 14. Talking just about some, I guess, some additional evidence, if you will, about what this ultimately means. How does the capital structure of a company impact value, or does it? So we're going to talk about what are referred to as some fallacies, right? Let's talk about leverage and earnings per share. Right? This company is currently an all-equity firm. It's going to generate EBIT of about 10 million. Currently has 10 million shares outstanding. Its stock is trading for a price of $7.50 a share. It's considering to change its capital structure by borrowing 15 million at 8% and using those proceeds to repurchase 2 million shares at the $7.50 per share. So it's going to recapitalize, borrow some money, and buy back some debt, or buy back equity. So they have no debt currently. There's no interest and no taxes. So essentially their earnings would equal their EBIT, and of course they would end up with an earnings per share prior to the leverage, prior to the change, of $1 per share. Now if it recapitalizes, right, it's going to have to make interest payments. That's going to total 1.2 million. That means its expected earnings after interest are going to drop to 8.8 million, and earnings per share are going to rise to $1.10. So this 8.8 million divided by the 8 gives us $1.10. So Levi's expectant, or LVI's, expected earnings are expected to increase with this leverage. So you might say, well, that's good then. I mean, that means something happened. Leverage increased the earnings per share of the company. But let's think about what really happened here. Even though earnings per share went up, let's not forget that the risk of that earnings per share also increased. So even though their earnings are going to go up a little bit on average, that's what's going to be necessary to compensate its shareholders for the additional risk that they're taking on, that they won't get any earnings per share at all. So again, in this case, the idea here that earnings per share go up and that means something, again, in this world of perfect markets, essentially what we can say is that nothing is happening here. There's no real change in the value or the worth of the shareholders' investment. Frequently we talk about dilution, right? If you increase the number of shares, that divides the fixed amount of earnings over that. That should mean there's a decrease in earnings per share. Sometimes, obviously, we talk about this. We don't want to offer shares because earnings will ultimately be diluted. So we want to stay away from that. So here's a company, right? They have no debt, 500 million shares of stock. They're currently trading at a price of $16. They're going to expand, so they need $1 billion to buy some new airplanes. They're going to finance all of that with new equity. So prior to the issue, the company is worth $8 billion. That's the 500 million shares times the 16 bucks a share. It's going to sell enough shares to get $1 billion. So at $16 a share, roughly it's going to sell 62.5 million shares. So what does the company ultimately look like? Again, here we have the change after the issue. We had $1 million in cash. Existing assets are $8 billion. So that gives us this $9,000. I'm going to get rid of the zeros. So the number of shares increases. Now, even though they've gone up, the value of the stock hasn't increased. It's not going to increase in a perfect capital market. As long as the firm sells these new shares at a fair price, there's no gain or loss to shareholders. Any gain or loss that's going to be associated with the transaction comes from the actual earnings of the project itself. So the financing piece doesn't impact value. It's the net present value of the assets that impacts value. So we have this conservation of fair value principle for financial markets. With perfect capital markets, financial transactions neither add nor destroy value. All they really do is repackage risk and therefore returns. So the debt will have a reduced, will be a reduced risk situation, and since we're going to substitute that debt for equity, the equity goes up, and it will be obviously then more expensive, and risk and equity would require a higher cost and higher return on equity. So in the end, essentially what this chapter tells us is that given the basics of a perfect capital market, now obviously we need to talk about that because there is no such thing as a perfect capital market. Essentially we're talking about a world that has no taxes, no transaction costs, everybody thinks the same. It's a very sterilized world. In that very sterilized situation, it is the cash flow of the company that's created from the assets of the company that create value. The financing choice is just a relationship between the investors that we choose to use. And as we move from debt to equity or equity back to debt, essentially we are shifting the risk from one place to another. But that overall change in risk is going to impact costs, and in the end, the actual cost of financing is not impacted. So again, in the perfect capital market, it doesn't matter how the company buys its assets. All that matters is that it buys assets that have positive net present value.